Hi Hugh, thanks for joining us today. You've been with IML for 4 years now, but just wondering if you could give us a bit of background on your experience before IML and the 20 odd years you've been in the industry.
Sure. Sam, I started in London at a company called Orbis, which is now launched in Australia, back in 1991. That was global investing. I came to Australia for lifestyle reasons, the sunshine and the lovely people, in 1995. So after 4 years with Orbis, and joined Platinum, so that was also global equity investing. And was with Platinum for a further 4 years before joining Perennial Value just after the tech boom. And I was with Perennial for about 6 years, I think, and then I started my own boutique called Cannae Capital Partners, which was also sponsored by Treasury Group, which is the major shareholder in Investors Mutual. So when Anton talked to me about working with him, we were both under the Treasury banner. We joined together in 2010.
And Hugh, the IML Concentrated Fund has recently been given a recommended rating by Zenith at their latest review. Maybe you could tell us how long the fund's been going and how the performance has been since inception.
Yes, Sam. Yes, the fund's, just as you say, been recommended by Zenith. It's had 3-year history. Over those 3 years, on an annualized basis, the performance has been just over 14% versus the benchmark index. The accumulation index has delivered 9%. So that's 5% outperformance per annum after fees. Obviously, it's a greater outperformance before fees, as some other managers report.
Thanks, Hugh. And what would you say are the key differences between the Concentrated Fund and the flagship Australian Share Fund?
Well, the Concentrated Fund has fewer stocks, so it's really our assessment of the best ideas we have. It's somewhat less diversified as a result of having fewer companies in the fund. I'm normally targeting between 15 and 25 shares, around 20 you could say as an average. But one of the other big differences is that it's not benchmark aware. So if a company is a very big company in the market, it may not offer very good value, and so I won't necessarily hold that company at all, whereas in the main share fund we tend to have to hold a reasonable proportion of our investments in the larger companies.
Thanks, Hugh.
Sure.
And given that the fund is more concentrated, would you say that it's a more risky investment?
Oh, far from it. It's interesting. I think a lot of concentrated funds are more risky because people don't have the diversification. And people sort of taking a big swing at a few stocks. In the case of the IML Concentrated Share Fund, the volatility is extremely low. The sensitivity to the market movement and the sort of the ups and downs of the markets has actually been very muted because of the kind of stocks that go into the fund. That is actually a hallmark of what IML does, is pick very steady, solid companies, high quality companies, and that's sort of particularly so in the case of concentrated funds. So that in the 3 years that the concentrated fund's been going, there have been some months where the market's been down quite significantly and the concentrated fund hasn't been down at all, or virtually not at all, and the concentrated fund has risen when the market has risen. So that overall you've had a very, very steady performance of the fund. It's been a nice steady growth trajectory, whereas the market's been up and down quite a lot. And so we're delivering a very low volatility outcome for investors.
Thanks, Hugh. And given that the fund is less volatile, what would a typical stock be in the portfolio, and what sort of characteristics would you be looking for?
Well, consistent with IML's philosophy, obviously we're looking for good quality stocks that we think are reasonably priced. And a stock, for example, that's been a big holding and been a big success for the fund has been CSL, the blood products company. And I think a lot of people think, oh, that's not a value stock because it is on a premium multiple to the rest of the market. However, if you look at CSL, it's had a track record of about 25% profit growth, profit per share growth for 20 years. There are very few companies in the market that come even close to that. And the company continues to grow. The company's got a very strong balance sheet. They're buying back their own shares. And they have grown through the GFC, through recession. They're one of the top global blood products companies, and we just got a new CEO there. He's very competent. He's been with the business for a very long time, and I can foresee continuing growth. And on the issue of, is it a value stock or not, I think, people need to sort of think, well, is value just about paying a cheap price? And I go back to 3-4 years ago when we were buying CSL at Investors Mutual. It was earning about $1.85 in 2009-10, and the share price was around $30. So we were paying 16 times, say. At the same time, we were selling QBE that was earning the same sort of earnings per share of about $1.90. Share price for QBE at that time was $25. So obviously that was the cheaper share. That was the value share, $25 versus a little bit over $30 for the same earnings. But QBE now is about $17 and is expected to earn about $1.25. QBE is $63 and is expected to earn over $3. So which was the cheap stock? Obviously, CSL has worked out to be the value stock.